I am the CEO of INTLFC Stone Markets, which is the swap dealer inside of INTLFC Stone. Also joining us is Tom Burnham, who's one of our senior grain traders, and Jake Moline, who is one of our senior risk consultants, also in the grain markets. The purpose of today's presentation is to go over the grain markets, the recent rally we've seen in the grain markets, and how OTC products can be applicable, improving not only your bottom line but your customers as well. My teeth were cut in the risk management space. That's where I built my career, is through risk management, understanding risk, and understanding how we can help solve problems when it comes to risk. That's what we do as a company as well, by offering access to markets and fostering deep relationships with our customer base, not only in grains but in interest rates, energy, and many other sectors as well. Inside of INTLFC Stone Markets, we have two principal service offerings. The first is education. Our first is advisory. Second is education. So our advisory services really come back to what I said earlier, is improving your bottom line and your customers, working to maximize your clients' revenue and our clients' revenue, and developing new hedge and grain origination programs. We do this through people like Jake joining us today and Tom Burnham. Tailored education, skilled educators offering customized training, effective hedge programs using our derivative products and portfolio construction. Some of the products that we offer this in are listed on the screen you see here. Grains, livestock, and energy. Many of you have exposures to this. For those of you that see something or don't see something you have exposure to, please reach out to your broker. I'm sure we can help you there as well. So let's talk about the benefits of trading OTC. The first are lower margin requirements. On average, you typically are required to post about 70 to 80% of what you would be posting on the exchange when trading OTC with us. So there are lower requirements for margin. Second, potential margin relief through threshold financing. This is a simple credit that we offer to some of our customers depending on their balance sheets. It enables them to have either less amounts of cash posted or have to send more or have to send less cash back and forth. So if this is not something you already have, please reach out to your broker and see if we can help you with this as well. Third, better matching of risk profile and business needs. With OTC, you have the ability to customize and create more suitable hedging mechanisms that fit your exposures in a tailored way. Fourth, liquidity. We offer liquidity in many areas that there is low liquidity or low open interest. That can be in fertilizer, lumber, further out contracts on the curve. So that's where our expertise is, and that's something that we can offer you. Fifth, confidentiality. It's extremely important that all of our products and all of our trades remain very confidential. The only people that know about our trades will be our customer and us. And lastly, our tailored structures to fit a market view. Many of you on this call are bearish, many of you are bullish, and many of you think we're going to be range bound. You can see on this next screen we've got different trades, different types of structures that can offer you hedging, a hedging mechanism that fits each one of those views. So if you are a producer or a farmer or a co-op and you need a hedge from the producer side, but you're bullish or you're bearish or you're range bound, we've got products that fit all of those market views. So what we'd like to do now is go over to the fundamental side, and I'd like to introduce again. This is Tom Burnham. We, affectionately call him Bub. So over to you, Bub.
Okay, thank you very much. I put together a chart that you see there, kind of whimsically, in which I tried to match the news that was coming out at the time for different highs and lows that occurred in the past year and a half in corn and soybeans. So you can have fun with that, looking at that. Kind of the takeaway from the chart, though, is how do we look at the news here at INTLFC Stone? We look at the news as kind of a lagging indicator, not a something that comes before market moves, but explains market moves after they happen. And what these charts kind of show is that all the news at market tops are generally extremely bullish, and all the news at market bottoms are extremely bearish. And then when markets turn to go lower or turn to go higher, as we've seen since April, news kind of comes behind and follows the move and explains what is happening and why that is happening. So the charts, the right-hand side of the chart kind of tells the story about what's going on in the corn and soybeans. Beans have gone vertical. Corn has had a very substantial, hefty rally. And it was not too long ago in April where the market was expected by most participants to top out maybe December corn at 390 and maybe soybeans, November soybeans at 950, something along those lines. And there were still fundamental analysts who were saying beans should be at $7 and corn should be at $3. So clearly that didn't happen. We're higher instead. So what did happen? What explained that? What explains what is going on with the market right now? Because on the face of it, our current new crop corn and our current new crop soybeans appears to be growing well, and they got it. Our farmers got it all in the ground, and so what explains the vicious rally that we've had? Well, I'm just going to mention three things. The three main things basically are the Argentinian soybean market had way too much rain, and it had a substantial negative impact on the finishing up of that crop as well as the harvesting of that crop. And when you talk about Argentina, you are talking a lot about the soybean meal market as well, because they're such a major exporter of meal. So the meal market is what really took off because end users had to scramble on the Argentinian news to cover themselves forward on buying meal that they need to buy. The second thing outside of Argentinian soybean market was the Brazilian corn market. And Brazil has had very odd weather, uncharacteristic weather in that some parts of the country are way too wet and some parts of the country are way too dry. And it happens to be the case that the safrinha corn, the second corn crop that they had there, has been just plagued by too hot and too dry. So that explains partially, at least, why corn began to rally. But the other thing that's happening in Brazil is the rally that we have, or the drought that they're experiencing there, the hot and dry that they're experiencing, is coming also on the heels of domestic shortage of corn. They've basically used up almost all their corn. So that's why we're seeing better exports for our own corn, and our corn, even at these prices above $4, is still competitively priced in the world market for end users.
Why don't we advance the slide to the corn chart here? So spend a little time on this chart as well. All right, go ahead.
Right.
Sorry, Bob.
So no, that's okay. So we have Argentinian soy too wet. We have the Brazilian corn too dry, which is cutting into our world supply. So, but there's a third thing, and by far probably the most important thing from the speculative funds point of view, and that's that we are making a transition from the El Nino weather pattern to La Nina, and the market is trading as if that La Nina hot and dry North American possibility is going to be a real probability, and it's not just a possibility. So they are building in a substantial, a very hefty weather pattern, or weather premium into that market, into both corn and soybeans. The caveat, of course, is this. As these charts show, market turns happen before the news changes, generally speaking. And the market top in corn and soybeans, who knows where it will be or when it will be. Timing it is impossible. But we do know one thing from having traded many years in these markets, and that is the market itself on the chart will turn before the news comes out as bearish. So the bearish news will follow a market turn whenever that happens. The good thing about the volatility we're seeing in both corn and soybeans, however, is this. I'll just mention two things. Number one, from our risk management point of view, we recommend that producers make incremental sales or marketing or pricing throughout the year. And on rallies such as this in the month of June, it's one of the ideal times to do that, where they're actually putting in a weather premium that's going to pay off with these higher prices. So it's attractive pricing or marketing for the producer at these levels. The second thing, though, and kind of transitioning into the over-the-counter space, and that's that the volatility that we're seeing in the futures market is translated into higher implied volatilities, much higher implied volatilities in the option markets. And when we have high implied volatility in the option markets, the levels at which over-the-counter structured products can be dealt at are much wider and much more attractive in a high volatility environment than they are in a low volatility environment. So that with that, I will end this little commentary and hand it off to Jake.
Okay, thanks, Bob. And Jake's going to be going over some specific structured products here that that are interesting and fit the current environment. So over to you, Jake.
Thank you, Mark. We're going to go through 3 different products today that we feel are most applicable to the current market condition. As Bob had pointed out there, we've seen a nice run up in prices here recently. Our demand picture has turned on a dime here from early this spring, and we're building in quite a bit of weather premium much earlier than we would usually see in the market. It's hard to believe that last year our corn market looked very similar to this year. We just started our rally about 1 month earlier. So we need to keep that in mind. We had a very big selling opportunity last year, and we cannot take our foot off the gas pedal this year and watch that slip by us, because if this La Nina hot, dry weather does not come to fruition, we'll see a similar sell-off. So the first product, and we're going to go through these in what I would like to call least amount of risk towards the most amount of risk, and these are all low-risk products that either have no double-up or a double-up potential pushed off into a different crop year, and we're choosing that because the market has rallied so high. We want to take away some of the risk of a knockout or a double-up potential in the same crop year. This first product here is the Producer Weekly Flex Floor Advantage. This works a lot like a minimum price contract, but it's a little bit different. Instead of buying a euro option that might cost you, say, 35 cents for an at-the-money Dees corn option, this product typically runs about 85% of the cost of a regular euro option, and that's because we're spreading the time value out between today and expiry versus concentrating all that time value at the very end. So how this product functions is we would start this when this was written up on the 10th of June, and it would end on the 25th of November. So we've got 25 weeks in that time frame, and let's say you had a producer who came in, he would like to set a floor, but he would also like to leave upside participation open. We're going to set that floor at the money or wherever Dees corn is. At this time it was at 433.5. And let's say he's going to sell 25,000 bushels to Grain Elevator X. Each week that producer is going to sell 1,000 bushels at either the floor level at 433.5 or that week's settlement. So he's got 25,000 bushels total. He's going to sell 1,000 bushels per week, no matter what, at either the floor level or higher. So before putting this on, this producer either needs to be bullish to the degree of the cost of the structure, which is 29 cents, or at least fearful enough to want to set a floor at the current level, which setting floors at the current level is a very good idea in my opinion at the moment. So some producers are hesitant to pay option premium up front. Typically when we see a grain elevator implement this into a cash contract, we're not requiring the producer to pay that 29 cents up front, but the grain elevator is paying that on their behalf and subtracting from the final price upon delivery. So if you look at this, he's going to pay 29 cents. As I said, some producers don't like to do that, and we've even seen some elevators incorporate selling a call option in order to finance that. So at the very bottom of the screen here, you can see that you can sell a D17 445 call option for 29 cents to make the cost of the structure zero. That producer just has, in effect, an offer to sell you next year's crop at 445 futures if we were to settle above 445 on D17 option expiry. But we're going to go ahead and work to the next one here. This next one is the what we like to call the old new producer accumulator with Euro double up and guaranteed quantity. That's a mouthful. I understand that. We like to look at this as two separate pricing structures. On the left there you'll see the old crop, and as in the first example we've got D's corn at 433.5. This producer is going to be accumulating sales on a weekly basis, just like with the flex floor, but this time above the current market at 453.5. A lot of producers, when it comes to accumulators, are hesitant to participate because of the double up possibility, especially with that being in the same crop year. With this product, we push that double up potential to the next crop year. So that producer is now more comfortable marketing a higher percentage of his bushels with this product, because if he were to get doubled up, it's during a different crop year where he has more supply. So in this example, let's say this producer's again selling 25,000 bushels. We've got 25 weeks. Each week he's selling 1,000 bushels up at 453.5, that green line. There is no double up potential in the old crop, but there is a knockout level. If at any time these 16 futures were to go touch the knockout level of 370, the remaining bushels are marketed out at the guaranteed level. The guaranteed level is usually set wherever the futures was when they put this product on. So if this product were to go the first 12 weeks, he's going to sell 12,000 bushels up at 453.5. Let's say week 13 we go touch 370. The remaining 13,000 bushels get priced at 433.5. So that's how the old crop portion of this functions.
So Jake, what's the worst case scenario in a trade like this, in your perspective, from the producer's perspective?
The worst case scenario is if the market were to fall off during the same week you put this on, it goes and touches 370, you would price all of your bushels at 433.5, which is where it was when you initiated the structure.
So, and what percentage of your overall bushels would you want to be exposed on a hedge like this, to drive home the suitability point?
Yep, that's a great question. With this particular product, it's higher than most structured products because your double up potential is pushed off to a different crop year where you have more supply. So we're more comfortable putting a higher percentage of our production in this because we have no double up potential in that crop year. Usually, a normal accumulator with the double up potential during the same time frame, we'd advise no more than 30%, meaning if you were to get doubled up, you'd have 60% of your crop sold. I mean, that's the very, very high side. We like spreading out our sales, as Bob said, and diversifying the way in which we sell our grain. So with this product, you could probably go up to 35, 40% of your expected production for this next crop year. Keep in mind, you're going to have the potential to sell 35% of next year or new crop 17 production if that would get doubled up. And we'll explain here on the right side of the screen, you've got a theoretical price action for D17 futures. You have a double up potential for new crop 17 if D17 futures were to settle at or above 455 on November 24th, 2017. you're going to sell an equal quantity. So keep in mind, in this example, we're selling 25,000 bushels of old crop. If D17 futures were to settle at 445 or above at the end of next November, you're going to sell an additional 25,000 bushels at 445 futures, even if the market has rallied past that. So that's how you're able to achieve that premium today, is with essentially an offer above the market for next year's crop.
Yeah, this is one of our more popular structures right now. So it's really nice being able to sell above the market with these wide ranges, and then also getting that guaranteed level in, and having the new crop be at, or actually it's above the accumulation in the old crop. So yeah, it looks good.
Yeah, and this one is going to be a little different from the next one we're going through. This one has that guaranteed quantity function, as you pointed out, Mark. A lot of producers, after seeing what happened with last year's corn market, it went down faster than it went up. We saw a lot of accumulators knocked out. So locking in that guaranteed level is something we would definitely advise at these price levels. But we're going to move on to the next one here. It's essentially the same product, but without the guaranteed level. And the levels look a little bit different here. We've got our double up potential at 440 for D17. And by bringing that down a little bit, as well as taking away that guaranteed level, we're able to achieve a little higher accumulation level. We're up at 475 this time. But keep in mind, as you can see here by star number 2, if the market were to go below 375, your remaining bushels are not priced out at a guaranteed level. You would keep the accumulated bushels up at 475, but the remaining bushels are knocked out and left open to the market. Your double up potential still exists at that point. We have a different barrier level for D17. In this example, it's at 325. If D17 were to go touch 325, your double up potential vanishes. But getting knocked out on the old crop does not knock you out on your new crop offer. So you can see this is a little bit higher risk type product, meaning we have knockout potential in old crop, but you can see here we're being rewarded to the upside with a little higher push above the current market, which is at 333.5. But I think a lot of producers like these products because they like to deliver grain in the fall. They don't have on-farm storage. We like to offer products that fit the producer's current storage situation. We hate, as much as grain elevators love storage revenue, in low commodity price environments, it's not a good investment on behalf of the producer. So we like to try to avoid that, deliver in the fall, have our double up potential structured for fall delivery as well. And that brings up another point where all of these levels are extremely customizable. You can end accumulators a little bit earlier if you'd like to know whether or not you have something sold by, say, the end of September for October delivery. The same thing with the flex floor. We could end that floor earlier. That's going to actually cheapen up the cost of your flex floor by taking away some of that expensive time value at the end. So all of these levels are extremely customizable. If that producer, in this example, in this slide, doesn't want to offer new crop corn at 440 but instead is more comfortable at 460, we can do that. We'll push that up, but that will bring your old crop accumulation level down a little bit. So all of it's extremely customizable. It's very important to make sure that you tailor a product to fit the producer's needs. Were you going to add?
Yeah, I was going to. Sorry to interrupt. I was going to talk. This is one of the examples where it is not a perfect hedge, but more of a revenue enhancement type trade. So the value and the levels you're getting are quite appealing, but when talking about the revenue enhancement type trades, I think it's also very important to talk about suitability. So can you go over a little bit how this would compare to the one we just went over in terms of a percentage of a portfolio?
Yeah, this one we might be a little less inclined to go at a higher percentage because it does have that knockout risk. It's a little more risky. But the same way with the last one we went through, your double up potential is pushed off to another crop year, and that's the main concern when looking at accumulator products. If you were to do just a regular December accumulator and sell, like I said, 30% of your crop that way and get doubled up, you would have 60% of your crop sold at one price level. That might be a little too high for one producer. So we like to dabble in these, use these as a way to jumpstart a marketing program and not finish a marketing program, because too often we see producers watch the opportunity that's in front of them, just like they did last year, only to see it vanish within a week and a half time frame, and haul their corn in the fall, put it on storage because they're unhappy with the price, end up spending 35 cents throughout the year on storage, and then they sell it in March at the low, right? So this is, as Bub said, a very good seasonal time frame to be initiating these types of products. And as Mark has pointed out, we want to make sure it's suitable, that producers are only doing a level that's suitable for them when it comes to expected production. And yeah, I mean, when we see volatility like we have recently in these markets, accumulator products look very good. What's funny though is in low price environments where we see very little volatility, that's when we see the most participation in these products. When in reality, we should see the most participation in these types of products right now, when we see the run-up in prices and the increase in volatility. But let's move on to the next slide here. We're going to just kind of walk through, I think, a couple of the next steps. Some of you guys on this viewing this video probably do already have an OTC account with FC Stone, with IFM, I guess. If that's the case and you'd like to learn more about either the products we went through today or some of the other products we offered, just contact your broker. If you do not have an OTC account with IFM, contact your broker, see if you meet the financial requirements to open an OTC account, and then you can go through some of the products that we've gone through. A big question we get is, how can my producer customer participate in these type of products without having an account with you? That's because there's a cash contract between the elevator or the corn buyer and the producer, and these are used as origination tools. So this producer is able to participate in this product because there's a cash contract that has a structure embedded into it. And having a comprehensive cash contract that mimics the way that these structures function is very important to protect both yourself, the grain buyer, and the producer. We've seen an increase in popularity and participation in these types of products, especially, as I said, in the low price environment. But a very important thing before deciding to either offer these out or offer out different types of products is to educate yourself, your staff, and your customer. That should be priority number one. We never want people participating in products that they don't understand. And that also plays into the fact that we want to make sure that a product is suitable for an individual. But any other things you guys would add with regard to that?
No, I think everything there was great, Jake, and I think you hit it home when saying that these are the types of environments where the ranges are most appealing for these types of products. And to get live quotes or to get actual indications or more information about any of this stuff, please do reach out to your broker. And if you'd like a copy of this presentation or like to see more of these slides, we'd be happy to provide that to you. So once again, thank you everybody that's participated and watched this presentation, and reach out to us if you have questions, and I hope to see you all soon. All right, thanks everybody.
Thank you.
Thanks.